Good evening. How are you? Campbell Venning speaking here with David Howes from the Property Consortium. And yeah, this is our first webinar after our first roadshow around the country, catching up with ex-positive real estate clients and new clients. It's been pretty cool. So I'll just do a bit of, well, normally do housekeeping for an event right now, but we're not an event. We're in one of our awesome offices. So yeah, I'm going to we're going to have about 1 hour webinar tonight to basically go through a few things and cover the items that we didn't cover the items for the people who didn't make it to the events on our webinar. So I'm with David, and he's going to give us a demo of the platform tonight, and I'm going to do a few other things and talk about property in general and property examples. So yeah, what's going on in the market at the moment, we are just very excited with what's happening in terms of the market and where we see it moving in the next few months and next couple of years. So yeah, so this is our first webinar post our first roadshow, as I said, and it was great to catch up with old customers that I hadn't seen for 15 years, and meet new ones who I met for the first time. So it's been really, really cool. So yeah, I will now give you to David to say his intro.
Hey everybody, thanks for joining us for the webinar tonight. We're in a great office here in Auckland with a view of the Sky Tower and a view of the city, which is pretty cool to look at. And we've got quite a bit of stuff to share with you, and I will just get that set up ready to go now, and then we'll dive on in. Thanks for getting here on time, and we've got a big Q&A session to do at the end. So any questions you've got, definitely make a note of them. We'll definitely come back to all the questions, and we won't leave until all the questions are answered. So make sure that you note any down, and you use the Q&A toolbar, not chat. It's easier for us to manage if we've got the questions coming through one location, not two or three. And we'll come back to all of those. So I will fire you back to Campbell, and we'll kick on into it.
Thanks, David. It's good that we've got a nice slippery desk on where we are. We're actually in Auckland at the moment, which is pretty cool, hence the Sky Tower. That gives it a little bit away. Um, this is the first webinar that I have actually done since we built the tech company in Australia that we listed on the stock exchange, on the ASX. And I was telling David before that back in those days, I was living in the country, and I was on 16 acres, little kids at school, etc. And I used to do my webinars in the garage. So I think I've come up in the world a little bit. We've got a beautiful office here in Auckland. So yeah, we for the people that haven't seen us live or the people that haven't seen us on a webinar before, we've been doing this for a very, very long time, and I'll give you a bit of a background in a minute um, about myself, and then David will do the same once he gives a demo of the tool. So yeah, um, we called this business the Property Consortium, and I thought that was a bit of a James Bond sort of move at the time. But if you look at it, consortium is a partnership or a union of two or more individuals working together to achieve a common goal. And that actually describes positive real estate back in the day, and it describes what we're trying to do to on another level from a tech point of view. But that's what we are. We're trying to help people, and the people that we've met in the last 4 weeks have been fantastic, and we've loved every minute of it. So um, I've got a bit of a cold because it's been a bit of furious few weeks, but I'm so excited to be back with old customers, new customers, but more importantly, where the market is right now, and we'll get into that later on. So a bit of an agenda here. We are going to do the some intros about us and some fundamentals around the investment world. We're going to do talk about new builds versus old, where we think the market is heading at the moment. We're going to talk about the data-driven investor, and that should be so much in your head because it's not about gut. It's not about the barbecue guy over the fence. It's about data-driven decisions, experience, expertise, and knowledge and wisdom. And I'm going to give you a few case studies at the end of the night with some pretty exciting deals that we've got to offer you. So, intro and fundamentals. So, my background, and I'll try and do this quickly because I can take a long time because it's a relatively long 35 years that I've had. Anyway, I fell into property in Wellington back in the 90s, and we bought our first flat property, our first three flat property in Upland Road, Kelburn. And fast forward 10 years, we did about 15 or 12, I thought it was 12, but about 15 renovations in 10 years. And we kept them all. And we had a decent rent roll, we had a decent amount of debt, and we had a decent amount of equity in our 20s. So we learned a lot the hard way because there was no rich dad, poor dad. There was no um, Robert Kiyosaki. There was no property investor association. There were no property managers in those days. So we had to sort of work it all out. And after a period of time, I decided to go and work for the finance guy that organised me organised all the debt, and he taught me financial literacy. And what that means is I when I before I met before I after that first property, it was pretty exciting. But then once the debt climbed, I got stressed, and I was in my 20s, early 30s. So I really needed to understand it. So I went and worked for this guy for 5 years. And this guy was one of the three most famous people in New Zealand's history in the last 50 years around investment and property as a business. We're in a tiny industry, and he was my mentor. I learned more from him than I've done anywhere else in terms of property, and it starts with finance. And if you haven't got a good finance person, you need to find one because they're critical, and we can offer you one because that's one of my biggest jobs is to keep the petrol on the people that we need to help our customers, and finance is critical. And not all finance brokers are created equal. Not all finance brokers are experienced because they've just entered the industry. It's the number one area that you need to look out for before you get to where we get when we start looking at property. So I did that for 5 years. My first business in property was actually in 2002, and that was amazing. I mean, I think I had about 40 staff running around the country doing seminars, doing giving advice, mentoring, coaching. It was awesome. I loved it. It was just so much fun. I then got into property development, and I wouldn't wish that on anybody because when it goes right, you've got your own jet. When it goes wrong, you're a nickel and dimer. It's extremely tough to be a property developer and win. And any property developer you meet, ask them, what's the biggest worry for you? He said, and they will always go, uh, we all go broke at some point. We just hope we're not next. And that's the standard property developer statement because in so many times I've seen where they do go broke, but they come back. So property development for me did that. Yeah, checked it out. Not me. I like the sales side of things. I like the advice side of things. I like the finance side of things, and all of that is in property development. But you've got to be a certain sort of person to be able to manage a 60 unit or 100 unit or a 200 unit building or complex. So I'll leave that to the ones that are a bit younger. So in my 50s, I actually enjoy the advice, finance, and property recommendation. So one of the other cool things that we've done in the past, David and we've worked together 5 times over a 20-something year period, and we built a software as a service business. Now, a software as a service business is a tech business, a prop tech business, and we actually listed this business on the stock exchange. We were in business with Fairfax Digital Media. We were on the main board of the stock exchange in Australia. It was pretty cool. And it was a $20 million list with a oversubscribed $5 million IPO, which was the initial public offering. And that company, that was down in 2009, and that company was sold last year to the Americans for 93 million. So we've actually had some pretty cool experience, but again, I wouldn't do that. I would not do a listed business again. I'd do a private offer to shareholders, but I would not list on the stock exchange. Too much compliance, too much red tape, and your shareholders don't actually have a lot of control when it comes to the big boys or girls that put the big money in. So we won't do that again, but we might offer shares, but they won't be listed on a stock exchange. So also I had a great 15, well not 15, it's probably about 9 years at Positive Real Estate. I was the founder of Positive Real Estate in 2011, and that was an Australian and New Zealand business. And that was awesome because it led with education. My wife's my wife is used to be a teacher. My daughter is a teacher. So there's education in the family, and I love helping people. Fast forward then, I also was the founder of the Property Factory, which is an on the it's a real estate agency that sells off the plan properties to mum and dad investors, first home buyers. And I'm proud of that business because one of the things I did in that business was a very cool tech uh, tool with David that we built within when we were both part of the Property Factory as owners and founders. And we built this tool that revolutionized qualifying customers, and it was pretty cool. And we've now built a similar tool to that, but it's about 500 times more powerful, amazing, and capable to help people understand their financial position. So all in all, I also owned Sotheby's Canterbury for a while. That was interesting. That was very interesting looking at $5 and $10 million houses and farms that were worth 30 million. But realistically, it wasn't an investment play for me. So I sold that business and I'm now back as a property guy for the Property Consortium. And it's pretty cool. I'm looking forward to helping a lot of you get into your property or get out of your property because, we've been through a tough time and some people are selling properties at the moment and we can help them do that as well. So that's me. And I'm going to give you to David again so he can tell you. Oh, no, he's going to talk to you later. Sorry. Right. So when when I wrote the thesis for the Property Factory, I did it out of Auckland University. It was kind of like my MBA. And I came up with this thesis and David actually then got involved and we built the Property Factory. So we've now had a new vision because the world's changed and it's not about prop tech. It's not about real estate agents. It's actually about finance and the customer. So the industry in our world is getting quite easier to match a customer buyer and the finance, which is almost robo finance now. So when it comes to actually transacting, we believe we can transact about 5 times faster than we used to for the customer. And because it can be slow and lethargic with finance, whereas now the banks are all so fast and pre-approvals and all the rest of it happens quickly. So what we've done now is built a pipeline business where you get a pre-approval or your funder or if your broker gets a pre-approval, we can match a property to you in the same transaction. It's very quick. No more mucking around on Trade Me. No more doing open homes. We can make a recommendation, give you property advice straight after we know where your finance is at through our financial advisor that is giving us that information. So our vision was to actually help people buy property, become landlords, but to do it faster and with less headaches than they used to. A lot of, positive real estate, people pay $10,000 for the education. They don't need to do that anymore. And we are now getting more and more clients onto the platform that, we're in recruitment mode again. So if you want a job in property investment, give me a call. So, that was our vision way back when. And we were in Hamilton last night and we got asked how do you guys get paid? And it was a good question because we've been in this industry for a long time. And the best way to describe us is that we're like a buyer's agency. Our services are free to the customer, but the people who pay us are the developers or the builders for the privilege of accessing our customers, right? So we charge them marketing fees to help articulate what the property looks like. There's a lot of work that goes in that, and you'll see that on our platform with our cash flows forecasts and all of the digital aspects of what we do in our platform that the customer can actually use themselves. But as fundamentally, we are a real estate agency that specializes in financial advice and real estate, and those two meet together very well under our way we operate. And we are real estate agents who only do investment property, who only do investment analysis, who only do investment recommendations around real estate. So there's only about 10 companies that do what we do in New Zealand, and there's about 15,000 real estate agents. And to this day, I will be very surprised if we hire a real estate agent. We don't want them because they're not typically trained in the world of investment, financial literacy, financial advice, etc. So most of the work we do is around recommending the right property to the customer based on the numbers that the financial advisor gives us. That's the easiest way for me to sort of wrap that up into sort of one sort of statement. So yeah, we get paid, but we don't get paid by you. We used to, but we don't anymore. So we're effectively a buyer's agency for investors. So that's a quick summary of what we do. Rightio. So I'm already behind a little bit, but that's okay. I'm always behind. So we do 4 stages of helping people. We plan with them, and we build a nice personalized plan for you. We find the right deals for you, and these are always wholesale deals. We've got partners because if it's your first time, you need a good lawyer, you need a good accountant, you need a good property manager, you need a good property coach, advisor, confidant. Um, it's not you on your own, and don't let it be you on your own. And at the end of it all, you should end up with a portfolio that will replace your income in retirement. And when I say your income, I'm talking your salary. If you're on 90 grand, come to us. We will help you get 90 grand, inflation increased by the time you retire. That's as simple as we are. And I joke with my friends that we're retirement planners. We're not. We use real estate as a financial product because people like you, if you're a first-time investor, can resonate with that. So that's what we do. And one of the questions we got 4 weeks ago was, well, how many properties do we need to replace our income? Now, a lot of people think it's a big number, and it's not. The average number of properties you need to replace your income today is about 4 or 5. Three's okay, four's good, five best. Any more than five, you're almost becoming a serial investor and a full-time investor, and that could impact your job. And we've seen people packing their jobs and trying to go full-time in investing, and it doesn't work. It's very hard. It's a passive business on the side. Do not pack up your day job today. So on average, you only need between 3 and 5 properties within 15 to 20 years, and you will retire on the same income you're on today using rent as your income versus your salaried or your contract income. So it's not rocket science, but it's amazing how many people stuff it up. So keep it. The best businesses in the world are the simple businesses. We got told by our chairman back in the prop tech business that the best businesses in the world are the most simple. Property is simple. Buy a property, put a tenant in, they pay the mortgage off. 20 years later, you've got an income in retirement. It's not hard. So that's how we work it. And it doesn't happen overnight. It's a slow grind. But if you listen to our advice, if you listen to the people who are around us, lawyers, accountants, financial advisors, brokers, you will do this. We've got clients right now that are retiring, and a lot of them come back and help because they've been looked after by people like us, and they want to come back and help. So, if anyone wants a job in investment property, talk to me, as I said earlier. So yeah, it doesn't have to take long. Right. We're going to jump to my area, and that's the actual asset, property asset. Forget finance for a second. So there are 4 different what I call asset classes in the world of property. I mean, there's probably a few more, rural, etc. But if I look at the main asset classes, residential is the lowest risk and the easiest one to understand. Residential housing turning into a property turning into an investment property. It becomes a rental. Same product that the builder's built could be a home, it will be a home to the tenant. But for you, it's a small business. It's your first investment property. It's a property that someone's living in, but the person living in it is paying off your mortgage. So psychologically, when you move into the old 7 hats or 5 hats, when you are buying your first rental, it's your first business. And it's a small business because it's 1 tenant or 2 tenants, 1 property or 2 bedroom property. And you are now a landlord, but in my world, you're a small business owner because you're responsible for the tenant and you own that real estate and you don't live in it. It is like a small business. Then we've got commercial, flipping, and development. People want to jump to commercial, and I stop them as quickly as I can. Commercial is far, far riskier, even though this graph shows it steps up a little bit. So much harder, so much riskier if things go wrong. You can lose a tenant for 3 years, 5 years. A lot of CBDs right now have vacant commercial spaces. So it might be a longer term lease, but you're not buying the lease, You're buying the building, and the tenant, if they fall over, your income. And if there's no more income, you still own that building, you still paying the mortgage, and you can be waiting years to get a new tenant. So the gap between residential and commercial is a lot wider. Now, you might want to be a trader or a flipper. Um, Sounds good. You watch the TV shows. I live in Maryvale, Christchurch. It's one of the most expensive suburbs in New Zealand per capita. And from a safety point of view, we're just around the corner from two hospitals, a park, tennis club, bowling club. We're in a really safe location. And we've had a significant capital gain in the last 8 years. And we are actually selling for to move different suburbs. And across the road, we've been watching one of Christchurch's biggest flippers, renovators, do up a beautiful old, stunning house that I used to look after for a friend because it was the friend's father's house. Um, so I know the house back to front, and he confided to me the other day that he's going to be 250 grand over capitalized at the end of it. And it's on the market now. It's not sold, but he believes, based, and so do I, based on this numbers he's given me, he's going to lose 250 grand on that project. Now, fortunately for him, he's a serial renovator and probably has six going at the same time, like I did in the 90s. So don't don't think you're going to be buying Williams Corp and flipping them for a profit. It's not going to happen. Do not do it. Stick to residential long-term renting, even short-term renting. It's risky. Keep it simple. Keep it simple. Keep it simple. It's just not worth it. So residential property is the lowest risk asset class. That's all you need to remember. And if people get excited and say, let's get this little centre together and buy the BNZ Centre, it's not going to happen. Don't let it happen. Be a safe, long-term, low-risk investor. Right, I'm now going to talk about geographical diversification, which sounds pretty cool. It's a big word, but geographical diversification in the world of property is that do not have all of your properties in Christchurch. Do not have all of your properties in Auckland. Do not have all of your properties in Westport. Because the reality is, locations don't perform the same. Auckland has always been our powerhouse. There's six cities in Auckland, and it's a complicated city because it's geographically connected. But the reality is, every single city and town and location in New Zealand has strengths and weaknesses. Auckland at the moment is in pain. It's in significant pain because it's had some of the biggest capital drops in terms of the capital values um, for a long time. And it's the first time in Auckland's history where Auckland has not led us out of recession. Okay. Canterbury and Queenstown are leading us out of recession right now. And every single property cycle, we'll talk about those like that term cycle later. Every property cycle spits us up with something new. And this current property cycle, this recession we're coming out of at the moment, the big thing that was real for property people was the fact that Auckland didn't pull us out of recession and that Wellington is still in pain. But guess what? Christchurch and Queenstown, they are going that way. It is happy days in both of those cities. Uh, I think Queenstown's on the cusp of becoming a city. It's not far away. It's got 50,000 people now, forecast to be 100, not that far away. It's one of the fastest growing, well, I think it is right now. It's the fastest growing place in New Zealand. So if you look at 216 to 226, Frankton, Queenstown, 30-year performance, 118% next to Auckland, 12%. But if you look at that from a historical point of view, it's the upside down. So one of the things about um, property cycles, it's not guaranteed. I didn't see that coming. I did not see Queenstown and Christchurch leading the country out of recession. That was interesting. But a lot of people have moved to the regions. They want to move to Dunedin. They want to move to Wanaka. They want to move to Queenstown. But I didn't realize how many people are doing that, and that impacts capital growth in those locations. So it is a science. Forget about it because even experts like us who have been doing this for 20 something years, we don't get it wrong, but we get surprised because you can't if you rush out into the sea and you've got big waves coming at you, you can't beat them. So capital values, capital cycle, or property cycles, um, it's good to know because that'll help you make better decisions, but it's not the oracle. And a lot of people think, oh, I'm just going to buy in Auckland. Well, look at Auckland at the moment. Negative capital discounts, sorry, capital drops of up to 30% in some suburbs. Scary times. So that's the example, I guess the fundamentals of your property portfolio has to be geographically diverse. Otherwise, all your eggs in one basket, executive summary. So that's the way we do it. So I'm now going to move to property 101. Right? Property 101, you've got your cash flow spreadsheet. You've been taught to beat the heck out of agents and beat them down in price. That's property 202 and property 303, and actually are about to start making some offers. Well, the first thing you've got to do is talk to people like us that know what they're doing. And a lot of investors make huge mistakes where they jump into the pretty properties. Oh, I like that one more. I like the brick. I like the curved brick. That's pretty cool. That's in right now. Reality is that stuff means nothing. It's all about the numbers and it's all about what you buy first. So let's look at this little seesaw of a property in Auckland and a property in Christchurch. The property in Auckland is negative cash flow. It is, someone's got to top that up. It's in Tor Bay, it's a nice location, but you've still got to top up the mortgage. And Kiwis don't like doing that. Let's go to the one in Christchurch and Riccarton. Our good friends have built this. It's purpose-built student accommodation, 4 bedroom, 4 bathroom. And this is the new student slum of Christchurch. And I'm not talking about this property, but I'm talking about my daughter and her flat is a student slum in Christchurch. And I'm hoping next year, if she stays a student, she'll go and work, she'll go and flat in one of these Upper Riccarton flats because they're brand new and they're not built yet. So we're starting to see product come out that suits the demographic. And for the poor property managers that manage the crappy old student flats in Riccarton, I take my hat off to them because um, my son and other daughter flattened in those places, and I couldn't get out of there quick enough because I thought I was going to catch something of the diseases that were going through that flat from a health and safety point of view. So this is a great product for cash flow because it's cash flow positive, but it is student accommodation, so it comes with strengths and weaknesses. So it's not from a cash flow point of view, great for your portfolio. And again, these properties are on our website. You can buy them on our website. I'm not buying them today, but I'm using them as an example of not every property suits every investor. It depends on your financial position. And we'll get to that soon. So that's this little cash flow versus capital growth. It's a saying, it's books, it's on podcasts, and it's how we articulate to customers, investors, what sort of properties they should buy. Rightio. So, new versus old. I'm old. Well, I'm not that old. I don't think I'm old. I feel very young, especially when I've had a couple of drinks. And on Saturday, I will be very vocal when I see the almighty All Blacks. Hopefully, give the French a bit of a whipping. So, if you haven't been to Kaha in Christchurch, oh my gosh, that stadium is world class. Best I rate. I'm a rugby madman. Best ground I've ever been to is Twickenham, and I've been to a lot of rugby grounds around the world, but there's something special about Twickenham. And I saw the All Blacks lose there. I saw them win there. Um, Suncorp Brisbane, unbelievable ground. I saw the Lions there. That was amazing. That was when I was with Positive Real Estate Australia, and we were with some of the Wallaby reserves. It was amazing, amazing experience. But Takaha, that's next level, international. It's not Twickenham, but I tell you what, it's not too far. So Saturday I'll be there cheering along, and that's a new stadium. The old stadium um, wasn't up for it after the earthquakes, but the old stadium in Wellington wasn't up for it either in Wellington. So everything dies eventually, including us, trees, old All Blacks stadiums. And let's use that for houses. New Zealand's housing stock is extremely old, right? And when I say extremely old, we're a young country worldwide, but our housing stock is extremely old. It's nearly all of not all of it, but all the properties from the first four ships, the people that built houses after that, are pulling them down and replacing them with townhouses, or they're spending way too much money to keep them on because it's an emotional experience for them. So there's a flight to new builds and there's a flight to smaller properties, and that's an international thing. But New Zealand's quite slow to that party, and it's accelerated in the last 10 years. And Christchurch has kind of led that charge. But today, here in Auckland, we went out, I want to say Hobsonville Point, but we went to Hobsonville and we went to the old Air Force Base and had a lunch. And honestly, it reminded me of Sydney. It really did. That whole, you get the ferry into the CBD, you've got a beautiful amenity, brand new houses, stunning apartments and townhouses, walkways, bikeways. Auckland has so much amazing amenity, and I compare it to Sydney. You know, I live in Christchurch, it's a beautiful city, and I cannot wait to get back into the sea suburbs where I met my wife. And but it's not Auckland, it's colder. But I don't mind. I grew up in Canterbury, so I'm used to the cold. But the bulk of Kiwis, especially migrants, they want to be warm. They want to be in the north. And Auckland will come right, and we believe it's just around the corner. And when I started looking at some of these properties in that sort of northwest corridor in Auckland, wow, that you get a lot for your money um, in that part of town. So yeah, we do not recommend you buy secondhand properties. We do not recommend you renovate secondhand properties. It is even for the experts. We've got some very good friends in the industry that do that, and they're shaking their heads. They're saying, Vinny, it's too hard. We might have to come and jump on your bandwagon with new builds. And I welcome them because it's same theory, different product. And we need more people in our industry that actually know what they're talking about when it comes to investment property. So yeah, houses are getting older. Also, houses are getting smaller, people-wise and footprint-wise. You know, the old quarter acre section, that's gone. Forget about it. And a lot of people don't want it. One of the reasons we're selling our house in Maryvale is that it's 5 bedrooms. It's got a 75 square meter pool house. It's got a big pool. At least that looks after itself. It's one of the ones that self-cleans. And we're on about 780 meters of land, which my beautiful wife has planted lots of awesome plants and roses and all sorts of things, but it needs maintenance. And, you know, in my 50s, I want to fly around the country seeing my kids. I want to fly around the world and see my family around the world. I don't want maintenance at home anymore. And I grew up in an apartment when I was 13 in Hong Kong, and I didn't do any maintenance. But now I'm at the point where I actually just want to enjoy life with my family and friends. And having a big old house to be looking after while I'm away and worrying about it, and something breaks if one of our kids are staying there, I just don't want the hassle. So as we get older, we actually want life to be a bit more simple. So internet, and this isn't my opinion, this is international. You know, people around the world are having smaller families, smaller household size. So the big old grandeur house is nice to look at, but it's a thing of the past. And yeah, I'll be sad selling our house, but the reality is when I get into a brand new spanking beautiful new build in Sumner and Christchurch Mount Pleasant or Richmond, who knows? I'll probably be converted for life. So yeah, housing changes. So to sum up that sort of diatribe of why property doesn't work, reality is it's the weather, and it's people not knowing how to fix their own houses. The cost of repair now is so high. Like we're doing 2 new bathrooms to get our house ready for sale at the moment. $90,000 for 2 bathrooms. I mean, I just think that's insane. Back in the day, that would have cost me 5 grand. So yeah, I'm out of touch with renovating old houses because we haven't done one for a while. Not interested, won't do it. Um, so yeah, old houses, they don't attract good tenants. New builds attract good tenants. You know, like attracts like. People who want to pay the least amount of rent are going to have a crappy property. If I was a tenant, I would pay a premium to get a nice house, and it would be new build. I would not rent an old house. And I haven't rented for, I don't know, 40 years. But even then, back in the day when we were renting, they were cold and miserable. Wellington, when we grew up together, not doing it. Secondly, when you're buying property, you get far better deals out of the banks when it comes to borrowing than you do secondhand. 80%, 90% in some situations for new builds. Old properties, you're lucky to get 70% lending. So it's not you're not getting the same leverage. And you get warranties with new houses. I mean, for goodness sake, it's like we just bought a new vehicle for the business, and it comes with a 5-year warranty. So if anything goes wrong with it, I don't have to think about it. So warranties are real, and they're real in real estate. Actually, that rhymes. That's quite good. I have to keep that one. So yeah, warranties on new builds. It's just a no-brainer. And we as a business used to sell second-hand property a long time ago. And after the Christchurch earthquakes, we made an executive decision. And I counseled a number of real estate agents in Christchurch at the time to see what their views were as well. And a lot of companies moved to new builds. And sorry, a lot of real estate agents started focusing on new builds. And so yeah, it makes sense. So forget secondhand properties. It's emotional, it's painful, and you'll be able to stop having paint under your fingernails. So property investments works when it's easy. Best businesses in the world are the simplest ones. So just to validate my point, this is a random property that we found in Auckland, and this is a student accommodation in Riccarton. Um, the old thing, the old $829,000 property in Auckland, um, is going to cost you 5 grand a year just to keep to own, even if you make it a rental. The property in Christchurch is going to make you 7.5 grand per annum. So get the emotion out. The nice sold quarter acre section that house could be on, forget about it. No matter how you look at it, it's not going to make you money. And if you take the gamble of renovating that and hoping you're going to make a capital gain that's bigger than 7.5 grand a year in cash flow from rent, keep away. It's flipping and it's not smart. So the 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 teaching around here is now this is where it gets a little bit complicated. We've got way more property types than we used to. In the old days, we just had cold and miserable single glazed houses that we all rented because that was it. We didn't have apartments in those days. We didn't have units. We didn't have house and land packages that were brand new. The Christchurch earthquakes made a huge change to our landscape. But before that, a house and land package, or sorry, a house and land product was very hard to make work as an investment unless you went way out to the regions where the price was so low and the rent was still okay. But the problem with it is that then you've got to look for your pool of tenants is smaller. So the world has changed when it comes to being a landlord. It's new builds, but you have got multiple product types: apartments, townhouses, units, and house and land. And obviously, the house and land is going to be what we call a growth asset. You're going to be topping that up. It's hard to get that. You can do it, but it's hard to get that to work from a cash flow point of view. And the apartments, that's where your rent comes from. That's your long-term asset because apartments are made out of steel and concrete. They're going to last 100 years. Whereas townhouses, they're not going to last 100 years. House and land aren't going to last 100 years, but they're going to last longer than a townhouse because they're built more sturdily and they've got land underneath them. So getting the product type to make your rental portfolio work is actually more complicated than you think. So we work on the basis of helping, the house and land package often is not cash flow positive, right? So what we do with that, we do things to increase it, and we buy a house and land package that has a secondary dwelling on it. You might have a three-bedroom three-bedroom house, and it'll have a one-bedroom apartment or standalone, on one title. So you've got effectively two incomes from one property. So we call these yield boosters. We're look at a property. We just did some conversions for some clients in Christchurch. They were getting $445 a week. We converted it to a short-term accommodation property. We staged it, we styled it properly, and it's now getting $900 a week because it's being run short-term. Not for the first property, not for the faint-hearted. There's a lot of work to understand when it comes to GST and changes of use. So it's not for everybody, but it's what we do with clients that are experienced in the world of long-term rentals, and now it's their turn to start looking at getting yield up. And there's lots of ways to do it: rent by room, short stay, duplex housing, duplex apartments. These are products that we use to increase yield. Right. When we look at property as a product, So this is my job. This is one of my, I'd say this is 50% of what I do.
Yeah.
50% of what I do is I go around and look at projects around the country. Up and down the country, it sounds like fun, but it's actually quite a bit of a pain in the ass because, I am looking, I try and look as much as I can, and there's so much stock out there. And for every 10 projects we review, only one or two pass the initial due diligence. And from the ones we select, 20 to 50% of properties that meet our financial metrics don't make the test. So we are really fussy with the properties that we select to then promote to you. So we do the legwork so you don't have to. So you don't have, and I don't want you to, because you will more than likely make the wrong decision with the regard to the property that you want to buy as an investment property, because they're not created equal, and your financial position is very much dictating what you should or shouldn't buy. And I've talked to a few wannabe property investors off the ledge before, and they've listened to me, and I've probably saved them 5 years of investing. So what I do, I talk to the developer, I grill the developer, I look at their balance sheet, where do you get your money from? I'm like the school teacher. And they were like, man, aren't you just here to get my listings so that you can sell my property? I go, no, I don't know if I want your property. I'm brutal with them. I used to be a developer, so I know how to talk to them. So the developer, the location, the project in terms of the master plan, the build quality, the design, the numbers are obviously critical. And at that point in time, when they tick all of those boxes, I'll then take on their property. A lot of developers just think we want it regardless. But we're fussy because one, it's a buyer's market right now, and two, some of the people in the industry build absolute rubbish property. And that's why it takes me so long to find pockets of developers who actually are ethical. They build properly. They come back when it's broken. We're staying in a developer's product at the moment. That's the developer needs to come back and do some repairs on it because it's only 3 years old and things are falling off. So and I know why they're falling off because it's been run short term. But yeah, when it comes to property, we look at everything and we call the developers back when things break and make sure they get their properties fixed. Um, Right, I'm going to hand you to David now because we're going to talk. David's going to talk about the property clock, and he does this really, really well. Um, and the property clock is basically a metaphor for where's this property cycle right now. So David's going to do it. He does this really, really well, better than I do. So I'm going to pass you over to him so you can have a different voice. And I'm giving to David now.
Okay, thanks, Campbell. Thanks for good work, and thanks for that big update and for keeping things moving along. That's really good. And of course, if anyone's got any questions, and type them in and send them through. So Petra's actually asked a question already, calculating cash flow. Does this consider interest being currently tax deductible? We calculate cash flow purely on rent received, all costs deducted, including 100% financing on the property and all the other related costs, and give you a net cash flow. What you then do after that with accumulating tax losses and using those to offset future income or future profits to defer tax payments, that's for you to handle with your accountant. But what we factor in is pure cash flow based on cash in, cash out, nothing to do with taxation or tax deductibility. So I hope that makes sense. Okay, cool. So I'm gonna just jump forward a little bit. Just by way of intro, similar to Campbell, I have been investing in property for a long time, and have a range of experience in property investment. By and far, I found buying and holding good properties a lot more fun, a lot easier than subdividing or renovating and building. And I've done some things property business wise on and off over the last 25 years as part of providing services to investors throughout 2 different countries now. And it's been a real privilege to partner with Campbell, with Real Estate Investor. They were listed on the ASX in 2015, and then the Property Factory, and then the Property Consortium most recently. Okay, let me just jump back. So the property clock, as Campbell talked about, it property clock, property cycle. It's just really a way of helping you understand in some great detail where the market sits right now. And this isn't just at a national level, but at a city level, at a suburb level. It's driven off the things that happen globally, Donald Trump, Iran, fuel prices, things that affect inflation, that then push up interest rates and cause changes in confidence in the market. But largely, it's quite predictable. Okay, so 12 o'clock, top of the screen, um, the end of a booming market before it starts to wobble. In some cases, go sideways. In some cases, end up in an oversupply situation, and then lead to construction rates dropping, and then tradespeople suddenly being available because of projects being cancelled or lack of projects being built. And then we end up in this sort of slump kind of a cycle where prices go sideways or drop with oversupplies. We've seen in Auckland and Wellington in particular, and then a situation where people start sitting on their hands, not purchasing, falling confidence creeps in, values start to fall, unemployment starts to rise. So we get to a point where we kind of bottom out and the market's going sideways again, and things get to the bottom of the cycle. And so right now, if we've been around the country the last couple of weeks, there's a general view that Auckland is somewhere between sort of 5 o'clock and 6 o'clock in terms of heading towards or at the bottom of the market. And if you're buying in premium locations, places with water views, close to the city, close to the beaches, then those parts of the city will probably recover earlier than parts of the city that are further from the CBD, maybe our West Auckland, maybe our South Auckland, where there's more supply, more land available, and there's not the real estate's not as limited, and so the city will recover at a graduated stages, with the most premium or the most popular properties starting to rise in value and demand first, and then it's spreading outwards with that ripple effect or with that ring effect, out to the suburbs and out to the Greenfields area. So we've got Auckland at the bottom of the market. We've got Christchurch and Queenstown somewhere around 7:30, 8 o'clock, depending on who you talk to. We've got Wellington or parts of Wellington, definitely late in the downward spiral, they're around 5:30, and so it's a really interesting time in the market because here's the thing, right? If Auckland's gone sideways well, up and back down over the last 5 years, and let's remember from 2016 to 2019, Auckland also went sideways. Then as we saw with that graph and saw that data from Campbell earlier, if key locations like East Coast Bays and Tor Bay have only grown 13% in real terms value-wise over the last 10 years, then it's all about, what's going to happen next. And so we really are at a stage where we've still got oversupply in parts of Auckland, parts of Wellington, all sorts of discounts and incentives available in some of those areas from some of those developers within some of those projects. And then we've got areas in Christchurch, Dunedin, Queenstown, ticking along quite nicely and have been for a few years, but still some opportunities within those locations. So the property cycle, we built into our site and it's built into every project, so that it's also supported by infrastructure projects and what are happening within the locations, so you can better understand where the market sits and really figure out when to buy, when to hold, when to sell if you need to sell, but to avoid buying at 12 o'clock, as a whole lot of people did 3 years ago, in places like Auckland and Wellington, and getting to the point where you're sick of it after 3 or 4 years of going sideways, maybe with yields that aren't so great, and then finding yourself selling below what you paid for property, and then going backwards. So it's an important tool to understand, in terms of your brain. Okay, so I'm going to quickly jump through just some economic indicators that we look at on a regular basis. And we kind of give them a traffic light system: red for danger or stop, orange for okay, and green for go. But if we just look at these 8 indicators, it's important to understand the big picture and not drive your knowledge off the newspaper headlines, because often there's small movements that aren't significant, but there's dramatic headlines that go with those in the New Zealand Herald or in the media, and they cause people to worry or think that the sky's falling when it's not. So if we just take migration, the last headline I read in the newspaper, in the New Zealand Herald, was that migration's still well below the post-COVID boom. Well, the post-COVID boom that happened after a year of no migration was always going to be playing catch up always going to have a larger than normal peak or spike, which you can see there. So we can never compare that to normal to that from here forward and have it make any sense. The real facts are since December 24, so a year and a half now, net migration has steadily increased again, and we're now back to about 90% of the long-term average. So, in the scheme of things, green light, steadily rising, increased migration, increased demand for housing, increased tenants, rising rents. Those are all the things we want to see. Employment. Again, unemployment in March was down a tad on the December quarter, even though it was expected to be up. We're in a pretty stable environment from an employment point of view. And again, if you look at the green line there, the long-term average, I mean, we're right on the long-term average or thereabouts. So, AI is impacting employment across the globe, but equally, if you read the real information behind or the real research behind AI, for every job we lose, it'll create two jobs if people transfer into the industries or sectors where there's demand. So, not all failures at a company level or downsizing at a company level necessarily means that the economy is going backwards as a whole. There's always opportunities. Okay, inflation's been pretty stable, but as we saw in February when the Iran war unfolded, fuel prices went up. That caused inflation to spike and caused extra costs across the country, particularly in the transport sector, and wasn't good for the economy. And so, interestingly, spending dropped in March and it's dropped further in April, and the country's quickly falling into line. And hopefully that conflict's easing now. But the good news is in May, when the Reserve Bank reviewed the official cash rate, they left it on hold on those spending patterns being positive, and hopefully when they meet again in July in a week or so, they do the same thing. So pretty stable. Interest rates, if you've been investing for 20, 30, 40 years, you'll know double-digit rates were the norm way back then. And if you're investing in the 2000 to 2015 period, you'll know that 7.5% was the norm. If you look at interest rates today, they're miles below long-term averages. And even though we have some adjustments here and there with inflation, overall interest rates are pretty stable and may increase a quarter to a 0.5% later this year. That's a RBNZ prediction, but may not as well, depending on what happens. House price growth, that's been flat for a while. House prices nationally are the same as 5 years ago. House price volumes in March in Auckland were up on last year in double digits. The opposite happened in April following the Iran issue, fuel price rises, lack of confidence, and so on and so forth. The good news is if you're looking to buy and expand your portfolio, there's deals to do. There's a buyer's market. There's a lot of choice, and there's opportunities. And so, volatility creates opportunity. If you pick the timing right and you pick the locations right, there's opportunities out there. So in terms of the property market, it's not all doom and gloom in terms of volumes either. Yes, volumes dropped in 2023 to just under 60,000 sales per year, but already we've now steadily recovered to the point where by April this year, we're back to just a tad under 80,000 property sales per year, and that's right on the long-term average. So, in terms of volumes, we're pretty stable right now when we take a long-term picture. One of the exciting things for investors is, despite property prices going sideways for 5 years, construction prices have increased almost 30%. So what that now means is if house prices don't start to rise somewhat and new property continues to feel price pressure, then eventually developers will stop developing at the rate they are, because if they can't maintain margins, they'll be unable to obtain lending, and they'll sit on their development sites for longer. So the good news is if that happens and supply reduces, excess demand will start to drive prices up. And so, we are in a place now where we can't continue to have construction price growth and prices not rise because it's not sustainable from a retail sale point of view for developers. The other thing is developers are smart. They do a lot of research. They're managing big risks. They're managing big numbers. And if you look at the new dwelling consents, you'll be you're excited to know that since September 24, getting on towards 2 years now, new consents have steadily increased on a monthly basis And year on year now, we're at 11% up on last year, with Canterbury and Auckland in particular really leading the way. So, you don't have that level of growth for new consents if there isn't confidence in what lies ahead from a supply and demand point of view. So in terms of the scorecard, really we've got three areas that are kind of so-so right now, mostly impacted by the fuel price spike and the Iran stuff, and we've got five green lights. And so, all in all, we're in pretty good shape, and I really encourage you to monitor and read this kind of information on a regular basis. Look at the graph, look at the data, don't look at the newspaper headlines because they're often dramatic and designed to drive clicks. Okay, so what I wanted to do briefly tonight, and this isn't designed to be a training session, but just really to illustrate the things that we've done and things we've developed here at the Property Consortium to help you manage risk and manage your portfolio, plan your future, and make more intelligent property investment decisions. So I'm just going to just jump right now into, let's see if I can do this. Oh, here we go. Nice little tool. Jump into the, actually, I think I might have to reshare that screen for it to appear. Property Consortium website. So I just want to explain a few outcomes that are possible if you spend a little bit of time. And some of these tools take a few minutes to set up. Some of them take a little bit longer if you've got your portfolio. But we're now heading towards probably $300 million worth of property held in portfolios by our members, and that's 10 times where we were sitting about 2 months ago. And that's happening because people are getting value out of the information that they see, and it's helping them to start to make decisions and manage their portfolios more strategically. So we've got a few features or a few areas in here that will really help you. So when you sign up and when you jump in, there's an area called My Investment Potential. And basically, the long and the short of that is you can build a plan that includes 9 key bits of information that help you work out where you're sitting right now and what your borrowing power is. It helps you work out whether you're weaker on equity or on cash flow. It helps you because you can then complete a risk profile assessment with yourself and your investing partner or spouse or loved one. And it helps you because you can set financial goals that relate to where you want to be in 15 to 20 years' time. So with the investment potential report, by supplying 9 different pieces of information around income and assets, liabilities, etc., you can quickly understand from a buying power point of view where you sit based on equity. And in this example, based on equity, I can borrow 6.5 million, but based on income or my debt servicing ratio or debt to income ratio, I can only borrow just over 1.1 million right now. So I understand already that I need to strengthen my cash flow or my debt servicing by buying more cash flow than just buying purely for capital growth. I can see a balance sheet picture and understand where I sit in terms of investors as a whole, and then I can jump into a section where we complete the risk profile. So this is the ability for you and your partner to answer 17 multi-choice questions and quickly understand, are you passive? Are you moderate investor? Are you aggressive investor? And when we put the two of you together as a couple, how does that picture look? Because if your poles apart as a couple, and that leads to making erratic decisions or doing nothing, you're not going to get very far. If you can recognize your strengths and weaknesses as investors and with risk, and you work together, you're more likely to define your roles and agree on a starting point that makes sense financially with a level of risk you can both live with until you increase your confidence. So as soon as we set some financial goals for the next 10 to 20 years, it's really easy for us to start to understand how we're going to get there. And if we do just that and start to, let me just close these tabs down. It's really easy to then say, okay, do I need 2 properties over the next 20 years? Do I need 4 properties? Do I need 5 properties? What number of properties do I need to understand my starting position, where I am today? And then if I add to my portfolio at 10 years, at 15 years, and at 20 years, what does the cash flow look like? Because a big part of this is just understanding where you want to end up, and then the easiest way to paint the numbers and get there. And this might be a little bit hard to see on your screen, but again, often we leave it too late, or we do too little too late, and we don't leverage off the benefit of inflation and compounding growth, and we don't get the growth in capital and growth in cash flow as soon as we can. And so in this example here, you can see 5 property purchases spread over 20 years leads to about $207,000 worth of net cash flow in 20 years' time. But if I play with that schedule and I buy more property sooner and less property later on, you can see with that just simple impact of the of inflation on rent and the compounding growth of property values, I'm now going to end up with $240,000 a year in 20 years' time, as opposed to 2.5, 2.10, 2.15. So it makes it really easy to say, cool, I've just got to focus on acquiring this many properties within this time frame, and then figure out what they are. So when we talk about the market and we talk about the property clock, what we have done is at a detailed level, at an analysis level, is set the property clock up for you to be able to drill down across the country and dive into each of the areas to understand not only how that location is performing, but also what are the infrastructure projects that have been developed right now, which suburbs will benefit from those projects, where are the places you should buy or you should consider they're going to benefit from some of the other growth drivers that are going on around the country. So use the market because that'll really help you with doing that kind of research, and it makes it easy to understand exactly where the country's heading. Put that to one side. Okay, cool. So hopefully by now, if you've logged into the Property Consortium, you've seen the projects area. And I really want to just illustrate here some things that make a big difference when you're looking to buy property off the plan or new projects that are recently completed. And that's understanding the numbers. And it's easy to buy property hoping for the best and not realizing maybe the cash cost and how long that's going to take to get from negative cash flow to positive cash flow. And in some cases, people go into projects, haven't done all their numbers, and they think they're going to be positive cash flow, and they end up with a real problem when they work out the true picture. So with the Property Consortium, not only do we analyze where the project is as a starting point and do all the cash flows, but we calculate cash flow on a weekly basis and then work out exactly how long and at what cost it's going to take you to get from negative cash flow, if that's where you start, to positive cash flow. And this is based on 100% finance. If you put in equity or cash into the property and you borrow at less than 100% finance, then your cash flow is going to be better. But this makes it really easy to sort the platform and understand where the cash flow projects are around the country. And we've got 8 different projects right now that are rent by the room or short term or on guaranteed fixed returns that are positive cash flow based on 100% finance. Some of them are furnished, some of them are unfurnished, some of them short stay, some of them are long stay. So dive into the platform because it's a really good opportunity to see and understand the project and the numbers. And when you dive into the platform, there's standard information in there, but also there's a whole lot of extra stuff in there as well that helps you to see the research we do around the location, around infrastructure, around amenities. You can understand clearly where the project is located. And as an investor, if I'm buying a project where transport or education is an important part of the customers I'm trying to attract from a tenancy point of view, then I want to know where is the public transport? How are they going to get to work? Where's the cycleways? Where's the motorways? Where are the schools? Where are the preschools? Where are the secondary schools and the universities? So we've wrapped that around every project so you can easily see from a project point of view that the infrastructure is in place, because you can easily buy in greenfields areas where the infrastructure and amenities hasn't been developed at stage one and have real issues getting tenants because the schools are still too far away or they haven't opened yet, etc., etc. So the Property Consortium, you've got clarity around what's for sale at what price. You can easily click on and open up the floor plans for the properties. You can see the cash flow calculations that we've done. You can open up those cash flow reports and see all of the detail, all of the assumptions, all the growth rates. And if you want to do your own analysis, all you got to do is click on customize and you can play with the numbers and adjust the numbers, costs, mortgages, vacancy rates, etc., to customize your own report. So it really makes it easy to see the information. And research is a big part of what we do. So we don't just look at the long-term trend, we look at the more recent trend. And with these sliders on these graphs, you can see the more recent picture in these locations. You can see where the market's heating or cooling. You can see where there's stock increasing or reducing in terms of under and oversupply. And you'll start to understand how Campbell's able to do these amazing deals with cashbacks and incentives and discounts in situations where there's oversupply and the market's leveling off right now. One of the important things about property, of course, with investment is if you can't get tenants, nothing will make sense. And so monitoring rents increasing and numbers of bonds being lodged is data we integrate to make sure that you easily understand and can easily see that there's actual real demand and it's not just good looking properties in locations where the demand's not there. So the platform's really designed to help you, make good investing decisions and to understand the logic behind what we do. And Campbell talked earlier about the projects that we filter out, and this is an example of we've built integrations around the country with a number of developers now, so projects come automatically into our platform and help us with all the pre-analysis. Just in the last 2 months, we've deleted 87 projects without even looking at them because Campbell knows the developer, he knows the location, he knows the project doesn't make sense. We've declined another 72 projects after reviewing them, because again, at a deeper level, the numbers didn't stack up. We've got 24 waiting for review, and we've got 52 for sale right now. So, if you think about that big picture right now, 50 out of 200 have made the cut. And then within that, in some projects, there might only be 3 or 4 where the numbers stack up, and others where the prices are higher and they don't stack up. So that's an example of us doing that due diligence. Now, finally, in the platform, if you add your portfolio, if you add your information to your statement of position, we've now built a consolidated report that acts as a mortgage application that you can send via PDF right now to your chosen mortgage broker. And this ensures that you do not need to fill out a mortgage application form separately. So if you maintain this information and you maintain your portfolio, along with the live information we track and monitor, you can move right away from filling in forms. And we're moving towards live integration with mortgage brokers to allow you to push this information through in real time. So, using the platform to search the market, to analyze the market, to track your portfolio, to see how you're performing, to understand what's great and what's poor, and to make decisions around properties that are going backwards or properties that are costing you in terms of negative cash flow, so you can easily understand, where to go next. Because with property, it's not automatic, it's not set and forget. Sometimes you need to take corrective action when things aren't working for you. Sometimes you've got properties you bought 20 years ago that need selling and replacing with better options. All right, so that's my speedy little read on that one, and I'm going to just jump back into. Um, give me a second while I just change the screen over and hand back to Campbell. I think we're good. Okay, Campbell,
Thanks,
back to
David.
you.
Sorry, guys and girls. Because we're recording this, we want to make sure that every other people who's going to download it can still see it later. So, the tech world is improving all the time, but even Zoom still has some limitations. So, David was talking about the platform. You can't really do it justice in half an hour. You can't actually do it justice in 2 hours. What we've built is a data-driven decision-making process for mum and dad to work out what's the best property for them. Now, we love what we do, and I have an online diary that you can click on and book me in for a catch-up. And because one of the things as a property coach or a property mentor or a property expert is that you've probably seen a lot of the things before, and what someone else's problem can become someone else's nightmare. But the reality is, a lot of the time, property is a long-term game. A lot of the issues are actually quite minor. So I'm a seasoned expert in helping people navigate the world of property. So I'm about to show you 4 deals. These are actual deals. They're not, we're calling them case studies, but they're actually deals. And they're deals that I haven't seen for a long time. And when I say that, it's a buyer's market. I said that earlier on. And a buyer's market means you're going to get the best deals you can. David was talking about the property clock, 6 o'clock. We're not talking at 12. We're talking at 6. I believe Auckland is just around the corner from 6 o'clock, and then it's going to start rising. The bad news about when it starts rising is our developers don't give us deals. Just prices go up and the numbers are harder. The time to buy is when developers are hurting and they're crying and they're screaming for pain, and the market's as flat as ever because that doesn't last forever. And the thing about Kiwis, we're so conservative that often we're too late to the party. Um, and it frustrates me. And I don't know if it was my time in Hong Kong as an expat brat. I don't know if it was my technology experience when I was in third form in Hong Kong. But I like to think I see things first, because it's so obvious to me. But the reality is people don't have the time and effort to analyze property. So I'm going to give you 4 case studies, but they're actual deals. And I went to one of these deals this afternoon, and I was like, why wouldn't you live in Hobsonville if you're an Aucklander? It's so new. I mean, Christchurch suburbs are new. Some of them are still old, but Christchurch suburb has new houses in old suburbs. Hobsonville is like a brand new, it's like Sydney. And I was talking to David today, we were having lunch. I said, this is like Sydney. I mean, Auckland's a beautiful city, but Sydney is an amazing city. And how quickly you can get around now with all the new motorways, the tunnel. Auckland has changed. It is not what it used to be. And for all of its, North South Island views on North Island, it will always be our economic powerhouse. I mean, I was down at the waterfront the other day, and the apartments that Willis Bond and other developers have built down there are amazing. So, you know, I've got no intention of moving to Auckland to live because our whole family structure is in the South Island, apart from one child up here. But if I was going to live in Auckland, you've got so much amazing choice. So these are rental properties, and the reality is, though, they could be your tenants for 10 years, and tenancy periods are getting longer. So it's not the fastest deal that you're after. It's not the best deal. It's the best deal, but it's the deal that suits your balance sheet. And our expertise is to help you make informed decisions so that you don't buy in the wrong location. So let's just kick off the one that I'm talking about, Hobsonville. We had a lovely lunch. And we had a lovely lunch at Hobsonville today. But the last time I was there, the amenity was about a quarter. And when I say the amenity, the offering for food, booze, houses, apartments, I mean, businesses down there, it's like a whole new city. And you get the ferry straight back into the CBD Auckland. So, if I was moving to New Zealand as a migrant, and I went around looking at all of the different places I could live, this would be top of the list because I don't have to drive. I can get the ferry to work if I'm in the CBD, and if I can bike because Hobsonville's they've got a lot of bike lanes. I mean, I just couldn't believe how the amenity had changed in a very short period of time because I probably hadn't been there for like 6 years. It's amazing. Anyway, one of our clients has given us a deal, 12 townhouses, 3 beds, 2 bath, 1 car park, waterfront location with unbelievable amenities, including the most expensive rest home in New Zealand across the road. Now, why is that relevant? It's relevant because people want to stay in the suburb where their families are as they get older. And this subdivision is going to have its own cafe. It's got water views, it's got walkways, bikeways, and if grandma and grandpa or mum and dad are in the rest home across the road, and you get a whole bunch of people doing the same thing there, that's capital value going up. So property is weird because it's not always about the numbers. It's often about the location. And David drove me around old Hobsonville today, and I was blown away how nice old Hobsonville was. So 800 grand in Auckland is a very low number for a house. And these aren't just houses. These are homes or rentals. And we went through some of them, and it's just like, wow. So not all suburbs are created equal. Um, when you are building an investment portfolio of the five properties, at least one of them needs to be in a capital growth location, but ideally two. But again, as we said before, the cash flow ones come first. So the Hobsonville Point or Hobsonville properties that we're looking at right now come with huge discounts to valuation, 72 grand below valuation. You don't get that. That's insane. And on top of that, they're giving customers a $20,000 cash back so that there's no top up for a significant amount of time. So it doesn't get much better than that. And when the market swings, those will all be off the table. Developers will pull that sort of stuff as quickly as possible. So this discount is exclusive to us for our customers. So don't miss out on it. I don't see these sorts of deals very often. So that's one of our projects, and we've got show units we can show you through. We can pick you up and give you a drive. We are actually organising a bus trip soon. So for the South Islanders or the Lower North Islanders, keep an eye on that because we'll be organising everything. And when you see it with your own eyes, you'll go, holy gamoly. Forget the photo. Actually walking around this area is insane. It's beautiful. It's really, really nice. So that's the first deal that we're looking at. It's a real deal. We've only got 12. I don't think they're going to last. Um, and we've got far more information on our platform that you can look at. But realistically, I'm the guy that makes the recommendations on this sort of stock. Pick up the phone, give me a call, and ask me anything about it. Because now that I've been down there and I've spent some time looking at the research, looking at the traffic ways, looking at the bike ways, looking at the ways you get to work, this is a no-brainer. And I think every investor should have something like this in their portfolio. So that's property number one. Um, these are the 30-year, 5-year, 20-year rents, bonds, sales, medians, etc. You can look at this online, so I'm not going to go through this. Otherwise, I'll keep you up for another night, another hour. But the reality is, this location has got a lot of reasons to buy from a metrics point of view. And to me, looking at the metrics, looking at the actual location, it's a no-brainer. So that's Hobsonville, Auckland. Petone Wellington. Now, Wellington is like a second home for me. I know it like the back of my hand. Got my first corporate job there. My kids were born there. We lived there for most of our life. My family and I, or my wife and my kids. But now we live in Christchurch. So there's nothing I don't know about Wellington when it comes to property. Now, the reason this deal is worth having a very good look at is that the developer has given us a 5-year lease back. Now, that doesn't happen very often. A guarantee 5-year lease back deal where you're getting cash injection on settlement to from a discount point of view, but you're getting it in cash. And it's $123 a week cash flow positive. This is what I describe. I mean, people will buy this as a home, but the reality is this is probably one of the most highest yielding properties we've seen for a long time. And it's got a 5-year guarantee from a developer who's been building for 20 years. And his balance sheet's bigger than most developers that I've met. And I know his balance sheet because he's confided in me over the years. So solid 750K properties with dual income, 2 income streams, a studio and a bedroom and a 1 bedroom, which is why he can offer it at this sort of level with a 5.5 net yield over 5 years. That's not very common. Now, I could spend another half hour explaining how that works. I've been through this complex. We are signing contracts with the developer on this complex in the next 24 hours because we want to have a base in Wellington as well. So the reality is, and the other thing about this developer, I have bought in almost every single project that he's built, and this is his latest one. And his first one was I think it was Positive Real Estate. Yeah, it was about 15 years ago. So I've bought and I've recommended, and every customer that I've put into this product, no complaints. And there's only 4 available in this deal, so don't miss out. It's a good deal. I can vouch for it as a customer, and you'll meet if you put a contract on this, you'll meet the developer, and we'll give you a full tour of a lot of his projects. But this is the one that he's selling at the moment. $123 a week, cash flow positive for 5 years. That's insane. But anyway, that's the Petone deal. Stats are there. You can look at those in your own time. And Petone is a suburb. If you're in Auckland, I'd compare it to Parnell. Um, if you're in Christchurch, I'd compare it to Sumner. I mean, Petone is, it used to be a grunge suburb. It's not anymore. It's a funky suburb. And you've got a brand new cycleway from Petone Central into Wellington. No more Hutt motorway getting run over by trucks and cars. You're on a cycleway all the way there. And that's huge amenity that's just literally opened in the last few weeks or maybe 2 months. And it's a very wide cycleway. Right, Birkenhead. Now, I've known this developer again probably for 10 plus years. Apartment complexes are complicated. People don't really understand them. They think, oh, I don't like body corporates, and the rents don't change and the properties don't go up in value. Well, in some instances, that's true. But with this project, it's a very small apartment complex. And Birkenhead is one stop over the Auckland Harbour Bridge if you're in the South Island. So if you're going north, you go across the Auckland Harbour Bridge, turn left, you're in Birkenhead. 12 minutes from the CBD in traffic. Like it's there. If there was a cycle lane across the Auckland Harbour Bridge, you can bike there. So you can ferry to this location. You can get the ferries. You can drive in 12 minutes. This location is so central, it's bizarre that the suburb hasn't exploded yet. So Birkenhead's an old suburb, and this is the latest and greatest building being built. It's not finished until next year, I think February. And these are prime apartments to the point that the one of the penthouses has already been sold. I think it was 4.8 million. There's another penthouse for 5 million. But we have identified four properties that are cash flow positive in the complex. Now, if you want a bolt hole in Auckland, you wouldn't buy one of those. You'd buy a bigger one. But the reality is there's four properties in this complex that are cash flow positive from 729 grand. I'm a huge advocate for apartment living. I've done it multiple times. I did it in Hong Kong on the 31st floor when I was an expat brat. Steel and concrete, safe, quiet, warm. It's just a great medium for living. And I'm sure in my dotage, I'll be living in an apartment with amazing views. What else? 30% of the building sold down, so it's not off the plan. The construction, the superstructure is actually finished in terms of its bulk, and now it's just getting fitted out with. So it is being built. It's not off the plan. The cash flow positive units that we've identified are $28 per week, and we've got long-term and short-term scenarios that we can help you with. So entry level, high-end project with what I call mixed use accommodation from penthouses down to one bedrooms that are very, very affordable. So fantastic project. Can't fault it. There's a show unit we can take you through. Yeah, let us know if you're interested and we'll take you for a tour. And again, the stats, the rents, the bonds, they all point in the right direction. And again, we do this math before we analyze something and say, right, what's the long-term view on this? And it's all good. And how couldn't it be when it's only just across the bridge from the Auckland CBD? So that's Birkenhead. And the project's called Chelsea Rise because it's right behind the old Chelsea sugar factory, and it can't get built out. I mean, it's a deal you need to consider. Right. My home, not quite hometown. I grew up in Rangiora, which is North Canterbury, and Woodend is right next to Waikuku Beach, which is where I became a surf life saving guard when I was 13, I think. Anyway, useless information, but I'm sure you're all really interested. So Woodend is one of the fastest growing suburbs in Christchurch. Rolleston was the fastest growing suburb in New Zealand for a long time. Then Queenstown took over, and right now in Christchurch, North Canterbury is just going through the roof, and it's because it's easy. It's at the end of the brand new motorway, the northbound motorway heading north out of Christchurch, and this suburb it's doing what Rolleston did, it's doing what Lincoln did, it's blending. So Rangiora, Woodend, Kaiapoi is coming together. Rangiora is the bigger town, Kaiapoi is the older town, and Woodend's becoming a new town because the Pegasus or Pegasus village has just kept getting bigger and bigger and bigger. And these are all amenities where kids can bike to Rangiora High. Um, Kids can go down to the beach. It's an understated location, and I know it back to front because that's where I grew up. We have selected, we have got a developer, builder, home and house and land package builder who's been in the business for 40 years. And they've got a selected number of what we call dual income house and land units for sale, a 3 bedroom plus a 1 bedroom for under $1 million. That's a good deal. And if you're an Aucklander and you're buying a 3 bedroom house that comes with a 1 bedroom house attached, you don't see that up here very often. And it's only 4 grand, just over 4 grand over 3 years to top it up. And when you do that math, the capital value of it will so outstrip the small amount of cash flow that you're putting into it. So don't be worried when your cost per week's 40 odd bucks. In the scheme of the future value of it, it's totally irrelevant. And if this was an apartment, those sorts of cash flow negatives would be irrelevant because you're paying body corporate fees. This is a house and land package. The land is what's the value with, and you've got effectively two houses on that land. So this is what we call a safe investment, 400 square meter site, 213 square meter house. We've only got two right now, and when they come up, we allocate them to customers. So we're promoting these on behalf of this developer. I don't think they'll last the week. And when they do go, I think it could be another month before we get any more. So we've got very limited supply of this product in this location because right now, Ravenswood, North Canterbury, Woody and Waikuku, Rangiora, it's the place that people are moving to if you want to go north of the Waimak. So that's Woody and Christchurch. Last one. Oh, I'm not going to go through the stats because I am behind. But again, everything's pointing strong. Property managers are telling us that places are renting. The forecast capital value is safe and it's good. And the long term is insane. So you can't go wrong there. So I thought that was our third project, but it's our fourth, David. So I can't count. So David and I are going to do Q&As, questions and answers now. Look at that. We've got quite a few people, which that's good news. Rightio. So David, do you want to have a okay? So
Question from Heidi.
Hey,
what does dual key mean, Campbell?
Dual key means you are buying a property, apartment, townhouse, house and land, where you've got two tenants that are separate from one another. And if it's in an apartment, it'll be a studio apartment, separate to the 1 bedroom apartment, but it's on the same title. So two houses for the price of one, two apartments for the price of one is the best one to explain it. Does that make sense, Heidi? Heidi?
And generally, you end up with rent getting pushed up about 30% more than you would for the same price property if you just had a 3 bedroom house or four bedroom house at the same value with a single rent coming in. So it turns properties into close to break even or cash flow positive. That would be well short of that from a
Well, and just
point of view.
and just on that, these are very rare. Like you don't see a lot of them. So when we see them, that's probably why you're asking the question. Dual key houses, apartments, townhouses are rare. So if you're in the market looking on TradeMe, you'll very rarely, you won't probably even know what they're described by because a real estate agent won't know how to describe them. So yeah.
Yeah, and just on that, Campbell, I mean, if you take a typical development, what percentage of stock would be allocated by the developer as part of the master plan to be allowed to be dual key by the home builders?
Oh, in a subdivision with house and land packages, 5% if that. Not even 10, it'll be less than 5. So it's a tiny amount. So we basically have them on order with the developers that we work with. And this developer's Signature Homes, and he's allocated those 2 units for us. So they're not going anywhere until someone puts their foot on it. Hence why I know it's going to go this week. And then we'll wait for the next two to come up or three. It just depends on zoning with council and land availability. So these are hard to find.
Yeah. Okay. Cool. Okay. So and just on that, just the questions so far. So just Somebody asked earlier, Steve said, I've got 15 properties right now. I'm not really sure how to go forward from here or whether I can go forward. What should I do next so that I don't just leap off the deep end and into one of these great deals?
Well, yeah. I think in terms of um, talk to us. I mean, the reality is our specialty is helping people make good decisions. It's not right now, it is a buyer's market. There is no hurry, right? You do not have to snap it up because someone else is going to get it, even though with those rare ones, we've got them on hold. So when it comes to working with us, we don't go fast. We look at your position, look at your balance sheet, look at your profit and loss, talk to our financial advisor, and then we make a considered, deep recommendation on your behalf because we're objective. You're not. Often people are emotional and they can make snap decisions that they regret later. And we spoke to a number of customers this week who they regret making a couple of purchase decisions that they did on their own.
And we were in Wellington last week, and I sat in on a session that you had with a lovely lady that was, early 60s, planning for retirement,
Yeah.
and she had some cash flow challenges. And just seeing you give her feedback on long term that she could change to short term, good properties that had long term tenants that didn't need managers anymore, that she could self manage, given she had, some part time available. I mean, some of the advice you gave her was going to add tens of thousands of dollars a year to her cash flow, and some of the changes were they weren't they weren't necessarily obvious, but they're quite simple and quite straightforward. And when you thought them through and looked at the impact, interest only versus P&I in one case, the collective impact across your portfolio was going to
Yeah.
double her cash flow, really.
Um, a lot of people get stressed and if cash flow's negative, right? And that's understandable. I get that. And this woman's situation or this customer's situation was extremely logical to me about what she should do. I can't just pull out the wand and make it go away. But I saw a very clear and defined plan to fix her frustration and stress because property has you've got a lot of levers with property. You can put you can put another tenant in if it's dual key property or no if it's so what am I talking about? If it's a dual key property, you could there's lots of things you could do. You could get rid of the property manager. You could put the rent up. You could convert it to short term in the event that it's allowed if you're allowed to do it in that area. There's lots of things you can do, but again, you need someone that knows what they're talking about to actually make that decision with you. So when it comes to problem solving, I love it. I mean, I think, okay, what would I do? And I'm an investor, and I've changed the structure of properties before midlife in terms of okay, this isn't working. What am I going to do? Well, and um, the last stand is selling. Right, I don't want to sell. I always want to hold, but sometimes you do need to sell, and it will make it easier to go forward. So there's nothing wrong with selling if you're doing it for the right reason, and we make those decisions with you under a very considered discussion. I've got a client in a popular real estate client who has just gone overseas, and he gave me an order to look at. When I say an order, it was an order of he wants me to help him. Um, but he basically signed off. He said, Venning, we want to sell half of the portfolio, 17 properties, if you can help us. And I've already half done the advice because it's not going to take me very long to finish it off. And it's a really clear cut what should be sold and what should be held. And then he's going to replace about five of those properties with brand new builds. And that'll be his income in retirement. So I love it. I absolutely love giving a client if it's a liquidation plan, sell plan, or if it's a buy plan. I love both because there is a solution out there for every single frustration, every single opportunity. Um, and yeah, we take this when we're selling, we do it slowly. We think about every scenario. When we're buying in this sort of market with these sorts of deals, at the moment you've got time, but I don't think that's going to last. So hence why we're doing bus trips up to Auckland and other locations. We're doing one-on-ones online. We are transacting with clients right now, and I love it. It's great. But very considered decision making. I've just seen a message here from Kerry. She's asked about what's happening in the Selwyn district. Have you done any research through there? Well, great question, Kerry, because I used to spend about $100,000 a year in research for the country before we made recommendations on property. So yeah, I do a lot of research, and we still do. But good news, you can actually benefit from our platform on our research. So I would recommend you spend some time in there, and we're going to have some guest speakers come onto these webinars soon, and some of them are very well known. So, but we've built this platform, Kerry, so that you can get the benefit of what we've built. So yeah, our research is far more than that. We've got it's deeper, to the point that forecasting, analysis, um, macro, micro. Yeah, research is a loose word. If I look at our platform, it's 80% research, analysis, forecasting. There's so much going on in there that research doesn't really do it a justice. Another one here. Is it a good time to sell or keep in Queenstown? Great question. Great question. So I think I said earlier on um, that this is the first time New Zealand's been led out of recession um, by not Auckland, right? So if you own a property in Queenstown, my I can't tell you what to do because I don't have the numbers, I don't have your information, but I would imagine you would kick yourself later because Queenstown is growing significantly, and that's making it slower for capital gains. But what a lot of people don't realize about Queenstown is if you're in the townhouse market that's, I don't know, 700 or 800 grand, that sounds like a lot of money in Queenstown. But I'll put this in context. One of the penthouses in Lakeview just sold for $30 million, and that's up by the gondola at the back of Queenstown. So Queenstown is a boom and bust location historically, but I don't think that's going to happen again. I think Queenstown is now moving to city level, and currently 50,000 people live in Queenstown, and it's forecast to go to 100. So that's not a small town. And Queenstown used to be a small town, and that's where the boom and bust came. I don't think we're going to see that again. I don't see any bust in Queenstown. Queenstown is a desirable location, and you've got the super rich there now. You've got the Aussies, and you've got the local Kiwis and the migrants settling down there. I think Queenstown's it used to be a risky location. I don't think it's a risky location at all. And I own property in Queenstown. So yeah, it is not a good time to sell. My advice, don't sell in Queenstown. Buy. Right. What else have we got here?
Heidi.
Heidi, if you're so this is from Heidi. If I want to talk to one of you about my personal situation, what is the best method to contact us? Okay, so David will explain that better than me on our website because it's very quick. You can book a time in with me, and depending what the problem is, or the issue is, or the opportunity is, we will make a diary time with you to do that.
Yes, sounds good, Campbell. I'll just quickly show you. I'll just take a second. And stop share, and we were gonna just share. Just got to jump with Zoom. You've got to jump between screens when you're sharing. So when you log in, if you go to the workspace area, you'll see in the workspace area when you're logged in, there's an area called Book Meeting. If you go into the Book Meeting area, which should be a screen, see on your screen now, as Campbell said, he does a couple of different sessions. One's a really high level 20-minute portfolio strategy review. One's a more detailed review, depending on what stage you're at. And so all you do is click through, choose your date, pick your time slot, and you can book that into his calendar. And that enables you to set yourself up with a time in the calendar without having to message backwards and forwards and say, when are you available, and so on and so forth. So makes it really easy to just jump in and book a session. The key thing is get your information, get your portfolio uploaded, get your statement of position uploaded, because it's easier to then spend the time looking at the picture once you have it than having to, sort of
Well, can I
put
just
teeth.
jump in there? Sorry, there's actually more than that. Right now, we're doing those meetings for free, right? Only condition is that you've got to put your financial information into our ecosystem or our platform, into the Property Consortium. It won't be free forever. There's no such thing as a free lunch. So make the most of me whilst it is free. I love doing it. Yeah, but at some point we'll have to charge for that because we'll be bringing on other property experts who will be available for those appointment times. So the appointment slots will never stop, but at some point there will be a fee associated with that. So make the most of me whilst I'm free. Sounds a bit
Okay.
cheap, doesn't it?
Yeah. No, it's it'll get busy. We've spent close to 2 years planning, designing, developing, building the property consortium. We went live late January, and we've made more updates and changes since then. We've had people start using the platform in the last 3 months, and it's growing quickly. So it's a good time. It's a good time
Yeah.
to jump in before we are buried under.
So we got any other questions, David?
That's all that have come through so far. If you got any other questions,
Oh,
but
there's one, is it? I know.
we cover that. Yep. So if you've got any other questions, definitely type them in and send them through. Just to pick your brain, Campbell. I mean, finance-wise, how important is that before you make the next leap in the current lending environment?
Well, finance is my kind of closet. I miss it. I really miss it. Did it for 5 years, as I spoke about earlier. And finance is the backbone of buying property. But we've got a new finance expert in the business, and she is so smart. She's been taught by one of the best. There are three famous people in the mortgage or finance industry in New Zealand, and one of them, I think they're all retired, apart from one. Anyway, the one that taught me bespoke lending. So the woman that we've just hired, her name's Caroline. She is a legend. She is as good as I got taught back in the day. And yeah, so we've also got in-house finance, and we're already seeing a pickup on that because not all mortgage brokers or finance people are created equal. In fact, it's probably one of the hardest things we've got. There's 12,000 finance people in New Zealand. Some of them just came out of finance school. I don't want one of them, no disrespect, because we've got customers with multiple properties, multiple portfolios. Some need to be sold, some need to be purchased. So when it comes to finance, it gets way more complicated in the investment world than buying your first home. If we get first home buyers and they come to us, we send them off to our other finance friends to look after them because they don't. It's not complicated. It's easy. But when it comes to investment finance, it's a different kettle of fish. So yeah, if Caroline will still look after you if you're looking for a mortgage for your home, but the reality is she'll get to the point that she'll be only dealing with property investors. What else have we got here? What do you think is better, Airbnb or tenants? That's a bit of a loaded question because there's no answer to that, Oliver. Um, I think if you're a first-time investor, you should have long-term tenants. If you're a seasoned investor, you should think about Airbnb. And Airbnb is a brand. The best way to describe it is short-term accommodation. So yeah, if you've just bought your first rental property and you want to convert it to short-term accommodation, don't. It's not for the faint-hearted. You need to be a landlord first to understand it. There's GST involved. There's change of use. And you're much more limited in the short-term world. And I'm in the short-term world, but I know what I'm doing. I've been doing it for a long time. Um, so I don't think something's better or worse. I think it suits the circumstance based on the age, stage, and expertise of the investor.
And not all properties are suited to short,
No,
so
absolutely
based
not.
on their location
No, no.
and,
Oh,
and,
no.
and the and, and the product.
I've seen people go into short-term accommodation in suburbs, which is just insane, and I just shake my head, and yeah, I'm gonna be careful with that. But the east side of Christchurch, there's people setting up short-term accommodation, and the tourism isn't there yet, and I think they're crazy, but. Sadly, the industry is open, and we have non-licensed people recommending things that I'd get scared about. So yeah, I'm very careful answering those questions because I know a lot of people have plowed into um, suburbs that the properties are cheap, but I just don't think the short-term rental is there. So yeah,
Yeah. Okay. And then we got is it Michelle? That next question?
Mitchell.
Mitchell.
Oh,
Michelle.
Michelle. Not a question, just feedback on the website. Love it. So much information, awesome functionality. Oh, thank you very much. We always like getting a compliment, Michelle. So yes, we've 2 years in the making. I think we tried to work out how much it cost, but all I can say is that it's in man hours and spend we're over 2 million US. So it's a lot of money, but it works and it's giving people what I'm hearing from the customers that I talk to. It's giving them more confidence around making informed decision on their own. And even though we're still here, if you can't get hold of us, if you spend some time in the platform, it is self-educating. Um, the way we've displayed the numbers, displayed the forecasts, the colors. I love the colors. Absolutely, and that was all David. The green, red, and blue, and the green and red to show cash flow positive, cash flow negative. It's just if you're a visual person, it's just so clear. I used to spend. I'll give you an example. Before we built this, I would spend 2 hours looking at someone's balance sheet, profit and loss, forecast, historical rental returns. I'd spend 2 hours, and then I'd be comfortable to talk to that client. I can do it now in 5 minutes because of the clarity of the platform showing me the balance sheet, profit and loss, forecasts, historical. It's really easy for me to do that because not because I've been doing it for a long time, but the information is so clear. So yeah, I'm your compliment, Michelle, um, is the same for me too. I mean, I'm finding it so much easier, and I'm probably doing 6 or 7 clients a day at the moment, and they're very short and sharp because I've got clarity about what I'm advising them on, and it's great. So yeah,
Well, and just your comment there, Michelle, about being empowered and able to then make informed decisions. I mean, that's the whole purpose, is to put usable tools in your hands so that you can confidently step forward and build your plan for the future. And see how we see the market and the opportunities and the numbers through our eyes. And then you've got valuations in there and plans and rental assessments and all the documents to support decision making. And if you've got all the tools in your hands and you're in control, then that really helps with being confident about what you do next.
yeah. How many people have we still got on, David? I'm just curious.
Still got over 100.
So one of the things I want to say, just in general, the amount of times, well, actually, we've just caught up with 4 groups of people: Auckland, Christchurch, Wellington, and Hamilton, the Tron. And I'm very sorry to the Tron people that didn't get their Hurricanes, that they didn't get their rugby win as a passionate Hurricanes supporter who lives in Christchurch. But we met some awesome people that I hadn't met before. And one of the things that I see people do is sit on their hands for too long. And I don't like people rushing out and buying. But when you've got someone who's giving you good advice, support, understanding, and logic, I mean, property isn't rocket science. But I hear it too many times. Oh, we should have bought then. We should have bought two. We should have done this. And it's not a race. But sometimes when your balance sheet is in good shape and the market's where it is now, we will recommend that you buy 2 properties or 3 properties. And they won't be in the same street or in the same city, but they'll be in safe locations that make sense for the long term. So, if I look at the crux of what I do, my job is to get the best deals from the best developers, right? Not the most expensive or not the cheapest, but the best developers and the best deals that suits our customers' balance sheets. So if I've got 20 clients, they're not all going to suit that one developer or the second developer. And it is a science. So and it's a hard science to replicate. Hence why recruitment's one of our biggest. That's what I was going to do. If there's anyone who comes from a finance background, we are recruiting right now. So please message me if you come from a finance background. If you're a real estate agent, please do not message me. No, I'm not. I'm being so. I love real estate agents. They're my friends, but I do not want anyone to apply for a job with us if you're a real estate agent. No disrespect. But we will give you secondhand listings to sell. So, but coming back to people who, I met a wonderful woman in Christchurch and the other day, and I'm going to interview her next week or when I can catch up with her. So we are recruiting, but we also back ourselves when it comes to um, judgment. I mean, I have not, touched wood, had a real estate agent authority complaint. I'm a licensed agent at the top level. If I do anything wrong, I have a 5-year stand down. Whereas Johnny, the real estate agent that started at Harcourt's last week, he gets nothing, but his boss gets a smack over the knuckle, not a 5-year stand down. So my license is extremely valuable to the what we do because I take it seriously. Because if I stuff it up, I could be stood down for 5 years. And touch wood, I've never had a complaint, and I've been doing this since 2001. So I love what I do, and I love helping people. But the reality is, I I also have to have a willing buyer, sorry, a willing customer who wants advice, who wants my expertise, because the 3 minute book read or the watching listening to 6 podcasts does not make you a significant investor. It's all about. I mean, I've had some nightmares to deal with, and I've worked through them for other customers and myself. So property goes wrong sometimes, and you want the. I'll use the metaphor of planes. I'm an absolute tragic plane spotter. I love flying, and but I got into a Middle Eastern plane once. It was an A380, and there was a kid sitting in the second seat. So there was a captain who looked 50, but the co-pilot looked about 18. And I think I went straight to the bar and had a few drinks just to calm down. You can fly a jet after 250 hours of flying, of training. 250 hours. There's airlines in the Northern Hemisphere that will literally let you fly an aeroplane after that many hours. That is terrifying. I want judgment and experience and knowledge. For when the big storm hits and you're up there, I want the 60-year-old pilot, not the 16-year-old pilot. And I use that metaphor in our industry. I actually love helping people because I'm a people person and you can change their lives. But if you're not, if you don't know what you're doing, and if you're a salesperson at Golden Homes or, um, any of the group home buildings, um, there's no license. They can say whatever they like, and that terrifies me. So, if there's one thing I want to do before I retire, and I'll probably retire in my 90s, um, I want to change the industry around group home builders, salespeople who are not licensed, they're not financial advisors, and they are making judgments on investment property to customers, and that scares the crap out of me. So that's my bugbear, and I'll be belting that drum for a long time because they shouldn't be allowed to, and they are.
Well said, Campbell. And we've got one question here from Heidi. It's come through. I agree, your website looks incredible. Thank you. I wish this type of data research and information was available many years to help me make more informed property decisions.
Can't change the past, but the good news is you've got it now, Heidi. So use it, read it, follow it, ask questions, do all that stuff.
Yeah, and the technology we've been able to develop over the last 2 years, we couldn't have developed 10 or 20 years ago at any price that would have made sense,
No, it's
let alone had the information available with
yeah,
data licensing costs. And when we built Real Estate Investor, first of its kind in the world to provide investment tools for investors, portfolio tracking, analysis, integration with zero, valuation and research tools. I mean, that we ended up paying about $1.5 million a year at the peak to license data for that platform. And so it's really hard to provide, a service at an economical price or even free when you have those kind of costs. So we've taken a different approach at this time with what we're doing. And yeah, it's really exciting.
it is. It is. And I think, back in the day, we started educating Kiwis in property investment in 2001. And I bought my first investment property in the 90s. So I was a seasoned investor when I hit that time. Um, we educated the masses, and the strategy hasn't changed much. But what's changed is the technology allows us to make even more informed decisions. It allows us to make l- taking less time. I mean, when I was mentoring people in 2001, yeah, they could be 2, 3 hour long meetings. Now, there's no way we could do that for free. Um, and one of the things, hence this website that we've built, is to help people quickly, but keep in touch with them. And you're a client of ours. And I don't want to charge, but there's no such thing as a free lunch. And the amount of investment we've put into this, if we make it free for a year, well, so be it. I don't care. We'll get a whole lot of clients and they'll buy property of us, and who knows, maybe it will be for free forever. I'm not sure. We'll just have to see how it goes. The reality is right now we've got a growing customer base, which is fantastic. They're typically coming from the other investment companies that we are around, which is cool, but that's not growing the industry of experts. So hence why we're recruiting so that we can train the trainer. And all of our competitors are doing the same thing, which is great. And I shouldn't call them competitors because they're actually just colleagues in the same industry. Like I said, 15,000 real estate agents, 10 companies that do what we do. Hence the cynical comment on wanting to hire. I'd love to hire a real estate agent that could be an investment specialist, but I haven't met one. So we have to go to the finance world and convert them and train them. Basically, if I hire somebody out of the finance world, they will be under my tutelage for 12 months. And that's typically the time it takes before someone's capable of giving informed advice as a financial advisor and or an expert real estate agent. Sorry, and or an expert investment agent, not real estate agent, an investment agent. Very different things. So, David, what else?
I think
Um, Anything else we should do apart from
I think we should, if we wrapped up now, it'd be just under 2 hours, which is a pretty good effort. And we really appreciate all of you putting aside the time tonight to spend almost 2 hours with us. And hopefully it's been valuable and informative. And we encourage you to dive in, get your portfolio in there, get your information in there, start learning from the data, and definitely contact us directly with anything you feel we can help with.
fantastic? Well, hey, thanks for logging in and being with us. I'm assuming we only budgeted 1 hour, did we? And I've taken two.
No, you're pretty good. Think about it. Yeah,
I'm
yeah.
famous for going over time.
I did tell them it would be about 90 minutes, so
Right,
we're pretty
okay.
much on time other than the
All right.
Q&A. So
That's
that's
not too
actually really
bad.
good. So yeah,
Okay.
yeah,
Well, I love what I do, and so do you. So
yeah,
yeah, you'll see more of us, and but yeah, just as an aside, you're on a webinar. We're doing more and more face-to-face meetings over the next few months and years. We love getting out and meeting the clients and showing them how we do the math, or sorry, do the research on the properties and check out the developers' products, etc. So tomorrow, for the next 2 days, I'm looking at stock up Auckland Way, and I can't wait. So
yeah.
awesome. Have a nice evening,
Okay,
and send your questions in and book me in.
cool. Thanks, Campbell, and great job tonight. And thanks for sharing your expertise with everybody. It's
Well,
um, it's been fantastic.
awesome.
Okay, we'll sign off there.